Welcome to Transmission. Today I'm here with Andrew and Daniel from LZF. Thanks for coming on today, guys.
Hey, thanks for having us.
You.
Excellent. So LZF is a exchange, but first I wanted to ask you guys a little bit about your background. Andrew, what is your background and how did you get into Bitcoin?
Well, my background going way back is computer science. For 17 years or so, I've been designing massively multiplayer role-playing games. The first one that came out is A Tale in the Desert. That came out in 2002 to 2003. To what they call critical acclaim. But it paid the bills for quite a few years, and then in 2010, October of 2010, we came out with Dragon's Tale, which is a Bitcoin-based gambling MMORPG. So a massively multiplayer role-playing game where the content is, rather than combat, real money gambling with Bitcoin. And I think at this point we're the longest running Bitcoin-based business in the world. We're certainly older than Mt. Gox. I think they were after that. And then for the last, Daniel, how long have we been developing LZF? Over a year.
About 2 years.
2 years, so. And so, yeah, that's my background, computer science and game design.
And how about you, Daniel? How did you get into Bitcoin and what's your background?
I got into Bitcoin when Andrew introduced me to the concept a few years ago. My background's in computer science as well. I've been operating high-traffic websites since I was 14. I used to work on iPhone apps.
Okay, great. Okay, excellent. All right. Well, what is LZF exactly? It's an exchange, but you guys do something a little different. You have a little bit of a different concept. Which one of you would like to tell us about the idea of magnitudes of stake and how that works at your exchange?
Okay, I can take that. So the whole or creating, there was something that bugged me about trading on other exchanges, and not just Bitcoin exchanges. Any commodity or stock exchange has the same problem, and that is when I place a limit order, I always feel like a little bit of a sucker because I'm providing information that clearly is valuable. You know, all these high-frequency trading guys find it valuable that I am putting out there what I'm willing to sell the commodity at or what I'm willing to buy it at, and I'm not being compensated for that. So, you know, the game designer in me, inherently I knew there's something wrong, and so I started thinking about how could you put the incentives on a market to get exactly the kind of behavior that you want. So what constitutes healthy behavior in a market, and how could you directly incentivize that? So there were four things that kind of struck me as good features of a healthy market. One of those is that there are lots of orders in play, so a deep market. That they tend to be close to the spread, so a tight market. It would be nice if the orders that trade have been there for a long time, so it's not just twitchy, high-frequency trading that's dominated by psychology, that it's real orders. And then the fourth thing is that those orders eventually do trade. So I came up with an algorithm that directly incentivizes those four things. And so there's this concept that you just alluded to. We call it stake of magnitude. And what it is, if you think of a buy order in a traditional Bitcoin for dollars exchange market, the magnitude of a buy order is simply the number of Bitcoins times the strike price. If I say I'm willing to buy 5 Bitcoins at $200 each, that's a stake of magnitude of 1,000. Okay? Ask orders are just the reverse. It's Bitcoins per dollar, so a very small number of Bitcoins per dollar, again times the number of units that you're asking.
Okay. Can I
so
ask? Excuse me. Sorry to interject. Can I just ask? I just want to kind of try to simplify it, if possible. So basically, the price of my order times the size of my order is my stake of magnitude.
That's correct. But keep in mind, it's a little bit different for bids and asks, because in bids, you want bids to be as high as possible. You want as many dollars per Bitcoin as possible. On the ask side, you want as few dollars per Bitcoin as possible. Or another way to think about it is as many Bitcoins per dollar as possible.
Right. Okay. So it's kind of turned on its head on the other side of the trade, of course.
That's
Okay.
right.
That's an interesting concept, and I found that really intriguing. Now I've been thinking about it for a while, and I also find it really interesting that you guys are involved in games because, well, trading is kind of a game in a way. So and I was trying to figure out how to game the system, but we'll figure it. I'll tell you about that later. I'm sure you've gone over a lot of scenarios, but I did want to ask. I was just, off the top of my head, I was thinking, what's to prevent me from, placing orders on both sides just to collect the royalties? Because the reason I have an incentive, if I understand correct me if I'm wrong, the reason I have an incentive to place these limit orders is because I'm going to get a kind of royalty for having them there as long as the order is filled at some point. And that's to prevent.
That's
Right. And so if anyone, I don't know if, I assume most of the people watching have traded on a Bitcoin exchange or any exchange, but if you haven't, what happens a lot is orders get pulled. So you'll see it'll look like, oh, there's a lot of support at 228, and then, whoops, that order for 1,000 Bitcoins is, quote, pulled, taken away, and the support is gone. So it's just the order book is basically a hologram. I think Chris, my friend Chris, always talked about that. He says that the order book is just a hologram, and I think that sometimes it is. So you want to, instead of making it a hologram, you want to make it something that people have an incentive to keep the order on the book, right?
correct. All right. So maybe there's one little thing you might have missed then going over the description, and that is the royalties. So we charge when you place either a limit or market order, we charge you a 1% royalty. So on the face of it, that makes us 1% more expensive to trade. Makes it 1% more expensive to trade on LZF than any other market. So that maybe sounds foolish.
Okay.
Well, you pay royalty to all the people when you're placing a bid. You're paying the royalty to everyone on the ask side of the order book. Everyone who has an existing order that has not yet traded gets a little piece of the 1% royalty that you're paying. In the case of the trade I talked about before, a bid for 5 Bitcoins at $200 each. So that would generate a royalty of $10, 1% of the value of the trade. And that 10%, that $10 gets split up, prorated based on everyone's stake of magnitude from the ask side of the order book. So if you're closer to the spread, you're tending to capture a greater chunk of that $10. And if you're trading for more units, if you're asking for more units, again, a greater chunk of that $10. So it's a competitive thing. It's good to have your orders in there for a long time, because then presumably lots of people over the course of time will place orders, and you'll collect a little piece of my $10 order and someone else's $20 royalty, and so on. So it's player. I'm going to keep doing that. I'm going to keep using the word players instead of traders.
Okay, that's fair enough. Fair enough.
It's traders who are paying royalties. Hopefully you have an order in place, and then those traders that come after you will pay royalties to you, and then maybe their order will sit there on the books for a while, and they'll collect royalties. So that's the reason why you can't just wash orders, place orders on both sides of the book and collect from yourself. You're not collecting from us, you're collecting from other traders. And so, yeah, you could collect partially from yourself, but other traders in the market will be collecting parts of your royalties. So it's a losing strategy. Furthermore, high-frequency trading will tend to be a losing strategy because you're paying these royalties. You are allowed to retract orders, but you don't get the royalty back. And furthermore, any royalty that has accumulated to your order gets redistributed to everyone on the same side of the order book. So if you pull a bid, any accumulated but not yet captured royalties get split up among all the other bidders, again, based on the weights of their stakes of magnitude.
I'm just wondering what if you guys have a plan for attracting people to this style, because it's a different style than most people are used to. I mean, if I tell someone, okay, come on and trade over here, you earn, royalty for putting a limit order, but it's a 1% fee, because they're just going to look at that as a 1% trading fee, and I believe there's a trading fee on top of that, the typical trading fee too. So it's really like 1.25% finally on the trade, but I'm going to get royalties that might cover the. It's kind of. I was trying to think of. Is that correct? Is that kind of what's going on?
That's all correct. That's all correct. So when an order does finally execute, yes, the house, the market itself takes 0.25% as a fee. So that's how we keep the lights on.
Right. Okay.
And how do people learn about it? How do we bootstrap the whole thing? If there were a group of traders out there that understand this, it should be self-bootstrapping. In other words, there is some advantage to, right now it doesn't take a lot of bitcoins or a lot of dollars to capture a large stake of magnitude. So if you think that some point in the future bitcoins are going to trade for 275 or 250, it might be a great idea to put some ask orders out there at 250 or 275. Let the market churn for a while. You'll be accumulating royalties. As long as your trade eventually executes, you will capture those royalties. So there's an advantage to putting orders out. Maybe you put some further away from the spread, which will not accumulate royalties as quickly, but will tend to accumulate for longer. Right. And maybe you put some close to the spread and try to accumulate faster. How do we bootstrap it, though? That's one of the problems with this exchange, that there is a learning curve. We have what I think is a pretty good user interface, and you can go in there for just very small amounts and place orders and watch trades happen, and you'll get emails saying your order has accumulated royalties, you have captured royalties, some of your orders have executed. So we really try talk you through, to let a trader know what's going on at every step of the process. So there's a learning curve, but we're really trying to handhold through it so that people learn this new way of trading.
What about market making? So a lot of exchanges, the reason that they're liquid and that there's volume and that you can trade on there and you don't have to wait 10 years for your order to get filled is because they're market makers that are, facilitating the market, that are being market makers, that are, and would that work with your model? Could I be a market maker on your exchange and still be able to do that because of the way it's set up, or would that be a self-defeating purpose?
And, another way to think of this scheme, another way to think of this method of trades is that everyone is a little bit a market maker. You're a market maker in proportion to how many units you're ordering, asking or bidding. You're a market maker in proportion to how close to the spread you are. You're only a market maker if the order eventually executes, and you're a market maker for as long as your order remains. So again, the four things that we're trying to incentivize are all a little bit of being a market maker. Now, you do pay the 1% royalty to sort of get in on it. But yeah, so there is no discontinuity. This word's going to come up a lot as we get into discussions about the algorithm. But there are no discontinuities in this algorithm. There's not defined roles for a market maker versus a normal trader.
Okay. All right, we've spoken about limit orders. I think briefly you mentioned market order. I think those are pretty clear. What about other order types? There are other order types that are really popular. Stop limit, fill or kill. There are iceberg orders. There's all kinds of stuff out there that is offered on Bitcoin exchanges currently, not to mention, in the institutional and other markets. So have you guys thought about adding other order types? Daniel, you want to take this one?
No, let Andrew take this one.
Okay, great.
Okay, so yeah, the other, and I had to look up what some of those order types are. My background is not finance, it's game design. And each of those order types, and I'm going to get into sort of the features in which are entirely new ways to do things like short sales and margin trading. Well, those two specifically. Each of the order types you mentioned, iceberg orders, stop and fill, that kind of thing, stop loss orders, they're each a way to prevent you from getting too much over your head when you do a margin trade or a short sale. Okay? Or they're a way to just if you have a bunch of Bitcoins, but in your mind you really are thinking in dollars, and you don't want the dollar figure in your head to go too low, those different order types can kind of help. But with all of those, you have a problem where, in the case of a short sale, let's say you short sell some Bitcoins, and surprise, the price starts going up. And now you owe Bitcoins. You have some dollars from the short sale, but now it's getting to the point where the dollars that you have from the short sale and what's in your account, any dollars you had before, maybe they're not enough to cover, they're not enough to repurchase those Bitcoins. So all the other markets kind of hand wave this. I'm going to describe a feature that we don't have released yet, but we're working on this. So this will be the next major feature. So what if there were a way to you short sell some Bitcoin, and you have some dollars ahead of time, and you say, I'm going to guarantee this repayment of these Bitcoins with both the dollars I had beforehand and the dollars I get from the short sale. Okay? The moment after you do the short sale, you should have enough. But the market needs to look on the order book and really make sure that you have enough. And if the price goes up, you have to, at all times, have enough dollars in the account, because we want to do this in a way that doesn't involve trying to collect from people after the fact. That just gets messy, and it gets into lawyers and credit checks and all this stuff. If the market if we define something called a stable market, which is one where if everyone who had a short sale, who just did a short sale but hasn't repaid back the commodity, and everyone who did a margin trade and has not yet paid back the currency, if they should all do that at the same time, repurchasing and selling the commodity as needed, as long as nobody goes underwater, owes money or owes Bitcoins, we'll call that a stable market. So if you were allowed to do margin trades and short sales where you put up a certain amount of Bitcoins or dollars to guarantee the repayment of the loan in either case, and the market enforced that there will never be a time when the order book can't simultaneously unwind or repay all those loans that are out there, that would be a really good way to do margin trades. You can say what your appetite for risk is. You would be mathematically guaranteed to never go to get underwater, to owe more than you explicitly said that you're risking. So that's what we're doing in the next version of the software. It will be something like margin trades, and I think margin trades are probably not quite the right word to use, but it will be sort of the equivalent of a margin trade with no predefined limit on how leveraged you can be. It will depend entirely on the order book and how much reserve you're putting in. And the same with short sales. No predefined limit to how much you have to have in reserve to repurchase should the asset go up.
I'd like to see how that works. I want to also ask something because you mentioned high frequency traders, and are you guys going to supply an API? And if so, are you going to supply one that uses WebSockets or the EraFix API? It's called FIX. It's one that the high frequency guys like to use typically. It's a very fast API. What's your opinion on that?
So there's no advantage to high frequency trading on our market yet. So currently the only APIs we do offer are read APIs for the order book, latest trades, and we sort of provide that upon request by sites that want to use it. So if there's a demand for any kind of API for placing orders or retracting orders, we could provide that as needed, but currently we don't offer that. And as far as WebSockets and Fix go, we'd be open to considering it, but we don't offer it currently.
All right.
Keep in mind that high-frequency trading would be welcomed by everyone else on the same side of the order book, because you'd be paying royalties like mad. People on the same side of the order book would be capturing would be accumulating your accumulated royalties, and people on the other side of the order book would be accumulating your paid royalties. So high-frequency trading, where you retract orders soon after you place them, is just a terrible strategy on our market.
Okay. I guess you can't tell me right now, but about how long should my order be on the book before I can get my 1% royalty back that I paid? Because I pay 1% to place an order, and I guess depending on the order book and on the market, it's going to take X amount of time to get the 1% back, because I don't want my I probably don't want my trade to be filled unless I'm going to get my 1% back. Does that make sense? Do you see what I'm asking?
Yeah, yeah, and I don't know the answer to that. I think maybe you're hinting at, like, how did you come up with 1% as a royalty fee?
Well,
Why
that's possible.
10%?
Well, sure, it could be any
Yeah.
arbitrary number theoretically, but one is okay. It's a easy to understand number. It's easy to multiply and add, so that's good.
So, and yeah, of course it's very hard to say how long in time it will take. A calculation, I can't do it in my head on the fly. If you had 10% stake of magnitude and you had a rate of incoming orders from other people on the other side of the order book of so much, yeah, you could do some calculation. Not how long in time it would take, but how long in number of orders it would take. I can't do it in my head.
Okay, great. So that's okay. So basically, if I want to buy 1 Bitcoin, then I need to have the value of one Bitcoin plus 1% plus 0.25%, right?
That's correct. And
Okay.
so what I expect that we'll see is that our market is not the market to trade in when things are just very gently moving sideways. That probably more of the trades will happen for people placing limit orders. That may be a fine time to place orders, but I think orders will tend to place as the market moves and in a way that lags a little bit behind the other markets out there. Because when the market moves, all of a sudden the orders on one side or another of the order book are good deals. And so, if the market moves 1%, and in the Bitcoin world, the 1% move is not such a rare occurrence. And by the way, that's part of how I came up with this 1%. By the way, that's the one thing about this whole thing that bugs me a little bit. The 1% is an arbitrary number, and nothing else in this whole algorithm is arbitrary. So we're going to go with the 1% to start with, and then maybe adjust in the future. In the future, I'd like to do markets that are like dollars for euros, so non-crypto markets. I think this method of trading applies very generally to all stock and commodity markets. And if I'm right, 10 years from now, they will all trade this way, and high-frequency trading will be a relic. But I think we will tend to see a lagging kind of trade for market orders and a ahead-of-time trade for limit orders.
All right, I want to talk about the security for your site. I noticed there was something called PS Key. Could you tell us what that is?
So PS Key fundamentally is a decentralized way of authenticating over the internet. It uses the next blockchain to store a public key, and then website operators such as LZF can reference an alias to query the next blockchain for your public key. And in doing this, you can sort of change both your public and private key for authentication purposes at any time. And the authentication tokens for connecting to a website change based on TOTP, which is the time-based one-time password algorithm. So it's kind of a method for very securely authenticating over the internet in a decentralized fashion.
All right, well, what are the risks compared to traditional 2FA? So most people are familiar with using that, and I guess the risk there is if my device is compromised. What if my device is compromised and I have something to authenticate using PS key. Is there anything I can do if my device is compromised in that case?
Sure. Actually, your device could be compromised, or the website could be compromised, and as so long as you have your private key for your next account, which is your password or your passphrase, you can actually invalidate or change your both your public and private key at any time. It would take about 60 seconds to propagate to the next blockchain.
All right, that's really interesting. I've never heard of anyone else. Did you invent that, Daniel?
Yes. And
Okay.
actually, there's a white paper that was published through the Internet Engineering Task Force website. So if you Google IETF and laissez-faire, you should see it.
Okay. Yeah, that's really interesting when I saw it. So I thought, yeah, maybe that's going to become a new standard or a new way to do it besides the traditional Google 2FA. It just kind of sounds weird to use Google for your high security stuff, right?
Sure.
Okay, yeah.
And I see
Uh,
PSKey as a way of fully authenticating and potentially even replacing passwords. I don't see it as just a two-factor authentication. I think
mhm.
potentially, if it was reviewed a little bit more, it could probably use as a universal way to authenticate over the internet.
Yeah, definitely. I could see that happening. Okay. Going on to some other topics related to exchanges. What do you think about the decision of the CFTC to call Bitcoin a commodity? And related to that, what do you think about BitLicense? You guys are based in the USA. How will these things affect your operations?
The CFTC ruling doesn't affect trading bitcoins themselves any more than the CFTC controls whether you can sell oranges to a friend. But what the CFTC does regulate is, can you sell contracts for oranges in the future to a friend, or contracts for bitcoins in the future, or options on bitcoins? That's something under their purview. So all the things derived from an asset like Bitcoin. I don't know if the way that I think, and I've just read not the CFTC's regulations themselves, but analyses of those regulations. I think that the way we're proposing to do margin trading or margin-like trading doesn't quite fall under their guidelines because there's no explicit liquidity provider. So in a traditional margin trade, the exchange hooks up a specific person, as I understand it. My background is not finance, but as I understand it, they hook up a specific person to loan you money, and they're just sort of brokering this. What I'm working on for the next version of LZF is an algorithm so that you never get in trouble in the first place. You don't need a specific person to loan you money. So it's like a counterparty-free way to do both short trades and margin trades. So I think it doesn't fall under the CFTC's purview. Lawyers who specialize in this stuff consulted with a couple of them, and they give kind of differing advice. I think it's as new to them as anyone else, and so other than that, I don't know how to answer the question, but that's, yeah.
Daniel,
I
do you have
can't.
any thoughts about BitLicense or the CFTC decision?
Um, I don't. Were you asking me? I didn't hear the first part of that.
Yeah, sorry, I was muted. I just want to know if you have any opinions about BitLicense or the CFTC decision.
Yeah, I don't really have any I can give it this time.
Okay, great.
The,
So,
the bit license
mhm,
bit
mhm.
license is clearly designed to limit the competition in the Bitcoin space to established players. Uh, New York is the one state that we don't operate in for that reason.
Okay, great. So you don't operate in New York. What about the ongoing block size limit discussion? What is your opinion about the block size limit discussion, and do you run a Bitcoin XT node?
We do not run a Bitcoin XT node. I think it's a little bit of a non-issue. I understand I think what they call PHI attack, where you deliberately flood the blockchain with small transactions. The net result of that is that it pushes the fee from a what's the word? It pushes it to a what the market will bear type fee from a whichever is the cheapest kind of. I don't want to call it race to the bottom, but it does. The existence of that attack does push the fees higher, makes it more profitable for miners. But the original Satoshi's original paper really does address that. It was intended that mining become a competitive thing, a competition for fees. So yeah, it accelerates when that happens, but it's not a big deal. It's not a disaster either way. So I guess I'm slightly in favor of leaving the one megabyte block size. Bitcoin was never intended as a micropayment solution. Satoshi said that in the original white paper. In the future, we're going to see Bitcoin used to settle things like real estate transactions, oil contracts, maybe purchase of vehicles, not for a cup of coffee.
Okay. Daniel, do you have any opinion about the block size discussion?
No, I never fully reviewed the system, so I don't want to give any opinion. Yeah, that's where I stand.
Okay, great. All right, well, thanks for coming on today. I really appreciate talking to you guys about your new exchange and new concept of trading. And, I encourage everyone to at least check it out and, decide if it's something for you. I'm still gonna be thinking about, what I think of it and how it all works, but I think it's a really interesting concept and a bit of an experiment to see if people are going to use it or how long it takes for people to use it and if people are willing to keep their limit orders on the book for a really long time. So let's see what happens.
Sounds good. All right. And by the way, there's a little chat widget on the lower right of lzf.com. Daniel and I are frequently in there. We're glad to discuss how things are working, and if you can come up with a strategy to metagame the system, we'd love to hear it. So far, I haven't heard one.
Okay, that was Transmission. Thanks for watching. Be sure to thumbs up this video, share this video, post your comments below, and we'll answer your comments as soon as possible. Don't forget to subscribe to the World Crypto Network. Thanks for watching, and see you next time.
Thanks. See ya.